Hello and welcome to Unleashed, the show that explores how to thrive as an independent professional. I'm your host, Will Bachman, and I'm excited to be here today with Neeraj Monga, who is a noted research analyst on equities and now a money manager. Neeraj, welcome to the show.
Thank you, Will.
So I love the story you were telling me earlier, Neeraj, about how you were writing for the Economic Times and writing some pieces that were slightly critical of some of the IPOs and so forth, and you ended up getting shut down. Tell me that story.
So what happened was that this is the boom 90s in India. So I would say year 95, 96, where IPOs were hot. But what was happening was there were a lot of unscrupulous small to medium businesses that were coming to the market to sell equity to investors. And there used to be, in those days, 15, 20 publications that would be published on Friday touting various IPOs. So I was specifically involved in actually going and doing the due diligence on one IPO where there was a family that ran a textile business in Ludhiana, which is in Punjab, where lots of textile businesses are based in India, and they wanted to expand into generating power. Independent power producers were coming out at the time in India. And once I went there and I looked at everything, I came back and I published a piece which was highly critical of the entire process. And I advised readers of the newspaper not to subscribe to that IPO. And subsequent to that, I wrote an editorial in the Economic Times where I was critical of the entire process of managing these IPOs and how they were coming to the market and how they seemed to be in favor of the unscrupulous individuals selling equities and not really in favor of protecting the investors. And that didn't go down well with the powers that be at the time in the Ministry of Finance in India. And it was indicated to me that such similar opinions will not be published for a certain period of time in the opinion pages in the Economic Times, which was India's largest financial daily at the time. And so that's the story. That was my first run-in with people who did not like my opinion and how it was shut down.
And then, I mean, so you got that word. I get it was someone at the ministry went and talked to the editor at the paper, and they gave that word to you, and you just said, "All right, fine, I quit."
Yes, I did leave the newspaper after I was informed that there would be some restrictions on what I could publish, and it was also not in the hand of, I guess, the paper or the editors at the time, because in the early 90s, India was still opening up, and they didn't want people writing too many critical stories which ran counter to the narrative of in India opening up.
Yeah, I mean, that's a fascinating story of kind of behind the scenes of how things can really work sometimes in the real world. But after that, you became you joined Bain for a couple of years, and then you worked as a equities research analyst, and really made your name uncovering some big accounting irregularities. Tell us some of the stories of some of the companies that you discovered some interesting findings.
So I joined a company called Veritas Investment Research in Toronto, which was a startup founded by Michael Palmer, who was a veteran Bay Street analyst at the time. And the Spitzer reforms had just been implemented in the US, and Canada was following in the footsteps. And previously in that year, Nortel had actually went bust, or was going bust around the time we were getting the business off the ground. And so Nortel was the first story, and Anthony Filippotti, who is the current president of Veritas, he was the analyst covering Nortel at the time, and I helped him cover the stock for a period of time. And ultimately, what was interesting, we found that Nortel, if I recall correctly now, because it's been almost 20 years, is that Nortel also had a financing arm, and Nortel would finance its own sales. So when the buyers failed to pay up, all the sales evaporated, and so did all the receivables. So and so many other things went wrong at Nortel. And ultimately, when Mike Zaporowski was, I believe, the last CEO, when he was in charge, I wrote the final report on Nortel saying this company was going to go bankrupt and not survive, given the issues that had arisen over a period of 10 years. And that did happen. The company did go bankrupt. My personal beginning as an analyst, independent, standalone, was a company called MDS Inc. MDS Inc. was Canada's leading healthcare company at the time. And I found their entire story to be fascinating. It was around a $3 billion market cap when I started coverage in September 2001. And everyone on Bay Street and Wall Street loved the company. But I just found that they had a lab business and they had a nuclear medicine business. And there was nothing really that stood out to me. And what I found even more fascinating was they launched something called a business called proteomics, which was at that time supposedly going to be a high growth business. And then I went, and they invited all the analysts to come to their facility here in Toronto and take a tour and understand what's going on. And they had this IBM supercomputer, which they had bought from IBM. And IBM had taken a stake in the proteomics business, valuing it very highly. What I found very interesting was that IBM took a stake in the business, gave them some cash, and that business took IBM's cash and bought a supercomputer from IBM. And I said, that's very interesting. So here's IBM saying that we are going to really back you and you are the guys. And there's this company taking their cash and actually giving it back to IBM and buying a supercomputer from them. But next steps, I go to the facility and they have all these individuals in white coats looking through microscopes into some plates, etc. And I looked at one of those things and it just reminded me of my grade 10 biology class. And I said, I remember in grade 10 in India, they said, peel the onion and put the onion under the microscope and you look at it and this is what it does. And I said, wow. So somehow after the tour, I didn't like that thing at all. So I came back and I started reading their annual financials in detail. And I found that they were building a nuclear reactor. I said, that's interesting. So they were building a nuclear reactor called the Maple Reactor here in Chalk River Laboratories near Ottawa. And like I was saying to you earlier, I had been reading so much for 30 years. I realized that no nuclear reactor has ever come on stream on budget and on time anywhere in the world. So how is this company going to build a nuclear reactor based on entirely new technology and bring it on stream on time and transition its production of isotopes from a nuclear reactor that is about to shut down, which was running at the end of its life? So I looked at it, and then Canada has an organization called the Canadian Nuclear Safety Commission. So I went there to see what they were saying about Maple reactors. And that brought out even more fascinating stuff. There's more than 5,000 or 10,000 pages of public hearings in terms of safety of nuclear reactors. And I read all those 5,000 or 10,000 pages that were there. And what was evident and clear to me that this Maple reactor is never going to come on stream. Because the problem with that Maple reactor was the same problem that Chernobyl had, which was that when the core heated up, the shut-off rods did not fall into the core of the reactor and could not shut the reactor down. So the reactor overheated, the core melted, and we know what happened with Chernobyl. So the Maple nuclear reactors also had a faulty design. It was evident in those pages. And they could not rectify the whole shut-off rod system. So I thought, well, the Canadian regulators will never allow this to come on stream. And they cannot just rectify it. So I wrote a research report highly critical of the whole thing, and I said that they have spent $500 million or more, and they're going to go, this thing is going to be written off, and this thing is never going to come on stream. So when the report was published, it created a lot of stir in the market. It was a buzz. And then wherever I would go, people would say, oh, that's the reactor guy. He's the reactor guy. But funnily enough, over time, they could not bring the reactor on stream. They had to write it off. They shut down. They had to sell out divisions to pay it off. And the whole company was sold in pieces. that's how my whole career in digging deeper and being more critical and finding the truth started.
Amazing story. Amazing story. Reading 5,000 pages of safety reports, not something every analyst would do. Tell me.
I found it fascinating.
Well, I mean, that probably relates to you. You were telling me before we recorded about how when you were a kid in 9th or 10th grade, you used to read the business press and remember statistics about companies the way some kids might remember statistics about cricket or baseball.
So, and I knew statistics about cricket as well, as much as anyone else.
Well, one question I have about the world of research analysts is, I mean, and your story illustrates it. Maybe you could, share some other examples. Is like beyond the information that's in the public 10K and the, just the reports that are publicly available. How do you go about getting insights on the company and discovering things that someone else hasn't discovered? Talk to me a little bit about how that is done. I mean, there's some philosophy out there, the efficient market hypothesis that all public information should be reflected in the stock price, and that if one person can read the report and look for accounting regularities, 100 people have probably also already done that. But it sounds like from your life and your work, that is not necessarily the case.
That's an interesting question. And I'm not one of those guys who doubts the efficient market hypothesis. But like you said, the efficient market hypothesis presumes that information is all out there in the market. And you will see stocks move, even recently when the so-called short sellers, they issue research reports of a certain viewpoint, stocks move a lot. And now those people whose stocks move negatively always try to paint that in a sad light, saying that these people have a vested interest. But the fact of the matter is stocks move because there is new information. But once that new information has come out today or tomorrow, the stocks will attain a new level of equilibrium. People would have digested that piece of information, investors and others, and they would have made a viewpoint. But there are many, many instances where information is not fully reflected. That's the whole game of alpha. Otherwise, you can just get the beta in the market. One of the issues I have observed is that investors tend to take publicly disclosed information at face value. And audited financial statements as gospel. So specifically in terms of audited financial statements, I think the disconnect is that many investors are not accountants, and most accountants are not investors. And accountants have a certain view of presenting information based on Financial Accounting Standard Board. But when you look at information from a critical standpoint, although an accountant may have presented information that is in line with the standard, it may not add up to what the business is. And so when you're trying to make an investment as an investor, you have to challenge the assumption of the accountant all the time. And it's as simple, it could be as simple as aggressive revenue recognition. Oh, the company might say, yeah, we had $1 billion in revenue. And last year we had $900 million in revenue. So our revenue grew by $100 million in the simplest terms. But the fact of the matter might be that $50 million of that revenue could have been booked by sending product to a friendly distributor. And the company could have a accounting policy that we recognize revenue upon shipment. So I ship to a friendly distributor and I book revenue. So when I look at the working capital, suddenly I have all this receivable because the distributor needs to be able to sell it before they can actually pay me. So now suddenly, between last year and this year, while my revenue went up 100 million, but 50 million might have gone up in receivables too. So I have booked all this non-cash earning and income, etc. This is in the simplest way where you can start your critical analysis. Aggressive revenue recognition is one of the easiest ways people can manipulate the financial statements. And then over time, accountants and everyone else has become far more creative. And now you can look at financial statements and they all are so creative that you can keep on working through layers and layers, and every layer will give you an answer that FASB says this is correct, or the accounting standard says this is correct, or the management says this is non-GAAP disclosure, but this is how we like to look at it. I'm not saying non-GAAP disclosures are not trustworthy or we should not pay attention to them. What I'm saying is that unless you have financial statements that are consistent and comparable over time, which is, I would say, 5 years, those financial statements don't have much relevance for making investing decisions. As an example, Uber gives incentives to customers. There are incentives on Uber Eats. There's also incentives on Uber Rides. Uber gives incentives to drivers to provide services. Uber gives incentives to customers to use its services. Uber gives incentives to old customers to provide referrals to new customers. Old customers get a referral incentive. The new customer gets an incentive to use the product, and a new driver gets an incentive to provide the ride. From a cash standpoint, each and every one of these things can be treated in a different way. And whichever way these things are treated, whether it is based on auditing standard, accounting standard, you can have either this as a reduction of revenue, you could have it as a sales and marketing expense, and you could expense it all in current year. You could say, oh, my customer has a life of 1 year. I expense it all in 1 year, the $1,000 that it cost me to gain a customer. You could say, actually, my customer has a life of 3 years. So this $1,000 I'm going to spend, capitalize, expense 300 this year, 300 next year, 300 the year after. So every action that you take is going to have a different impact on your financial statement. And in any year, if you change that action in terms of the accounting policy you're following, your financial statement will get restated. So for instance, Uber has $2 billion of incentives that it is recognizing in revenue and expensing in sales and marketing. If it chose to recognize revenue based on the net revenue it gets after the incentive, because it's a non-cash number, Uber's revenues could be down $2 billion. But that's not the accounting policy they are following. I'm not saying Uber's accounting policies are offside. They have disclosures and they have accounting notes and they have footnotes and they have FASB interpretations and they have accounting standard guidelines, which are all there somewhere in 1, 2, or 3 annual reports if you read them. But that's what Uber's financial statement is. But I don't know how many people who buy Uber stock know that there is $2 billion of annual expense, which is recognized as revenue. So that's what I would say. It's a long-winded answer, I think, to your question.
Yeah. Share another story. I know there's been a number of these firms where you've discovered things like you did with MDS. Give us another case study.
Well, another case study in terms of finding information that is not in a financial statement would be many years ago, my associate Chris Silvestri and I, we worked on a directories business in Canada, which is the telephone directories business. It was called the Yellow Media Income Fund, which was Canada's largest directory business. And the company kept on buying directories or smaller companies and was reporting revenue growth and free cash flow growth. But what the financial statements and the entire market missed was that Google was gaining traction. People were beginning to search online. And the size of those directories was thinning out. So the company was raising prices, 1. 2, it was buying other dying directory publishers and then showing revenue growth and free cash flow growth. And so the two of us, we spread across the country, and in 13 cities of Canada, we collected directories for a period of 5 years. And we counted every ad in every directory and every placement. And whether it was black and white or color. I think it took us 45 days to do that. And what we found was that in every city of Canada, in every directory that we looked at, number of pages and ads were declining. The size of the ads was going down. There was more black and white than color, which proved that fundamentally the business was already facing decline because of the rise of the web, and the usage was going down. And then the other thing we found out was that we would go to these condo buildings where directories are delivered in a truck, and they would tell us that a week after the directories were delivered, 90% of them were actually thrown into the recycle bin. And so at the time when I published that report in 2007, it was called The Count of Yellow Pages. It was a $10 billion stock. And I was the only analyst on the street to be negative. And then when I published my report, 13 other analysts on Bay Street after a couple of days published a report, their own reports, making fun of my report, saying I had no idea what I was doing. And one of them actually published a report with the first cover page with 2 paragraphs reading backwards, implying I had no idea what I was reading either. And then I published a report after that in September titled The Face Off, which actually explained why everyone else on Bay Street and in Canada and all the bankers and everybody who owned the stock was wrong. And that what we had done covered 90% of Canada's GDP and approximately 80% of Canada's population. And that's what happened. Within 2 years, the company went bankrupt.
Whoa. That is amazing. So you collected 45 days. You counted ads and looked at 5 years worth of yellow pages for all these different towns. Wow, that's really doing the digging and doing the work.
Right, and what we found interesting was that the company did not refute anything we said. Because we told them, I think we had counted 95,000 advertisements in one directory or something. So I don't remember the data now. It's 2007, the report was published. But we highlighted every table, everything we counted by city, by directory, by state, by province, by type. Because they had, in their annual information form, they would disclose the top 10 categories of advertisers that were in those directories. And we counted all those top 10 category advertisers as well, and we showed all these categories were declining too. So there was another company that went bust, and one of Canada's hedge fund billionaires, Eric Sprott, used to own stock in that company called Timinco. And Timinco was an interesting company because, and that was, these days solar is hot, and even 2007 solar was really hot. So they were in the manufacturing polysilicon business. And Eric Schimmelbusch used to be one of the big shareholders, and Eric Sprott, who was Canada's hedge fund lead at the time, he was invested in that company. And both of them made to the cover of the Canadian Business magazine, highlighting their investment prowess and their strategic insight in terms of building the polysilicon business. And I didn't believe it for a moment that what they were saying was worth anything. And I just thought that they were selling sand to people. And so we did the digging there, and their whole claim to fame was that they had a patent with they had a patent on their production method of polysilicon in World Trade Patent Organization, some organization in Europe. It was not in the US. So I downloaded that patent, and I read that patent, and it seemed a lot of hodgepodge mishmash to me, but I was not a physicist or a photovoltaic engineer. So what I did was I bought the handbook of photovoltaic engineering. It was like a 600-page handbook that they use in the master's program in University of Toronto and Queen's University for photovoltaic engineering. And I read every page. And when I say I read every page, it does not mean I read it cover to cover. I read and flipped the headlines of every page. And I came to a page where there was a paragraph, and I said, this paragraph I have read somewhere else. And I said, where have I read this paragraph? I was thinking for a while, and I went back to reading the patent of this organization called Siminco. And that paragraph had been lifted from this book. And I said, wow, this is interesting. So Chris Silvestri was working with me on that too. So the two of us, we read that again and again, and then we figured out, and we just figured out this was all just a fraud. So we basically took that paragraph from the book and sourced it from the book, and we took this paragraph from their story and sourced it from their patent. And then we wrote a 26-page report, which basically said that this was going to blow up and it was all a fraud. And it was a $34 stock. I think it was $3, $4, $5 billion company. I don't remember now. And within 3 months or 6 months, it went to zero. And we proved it.
Wow, that's amazing.
So, yeah, I was proud of that, finding that paragraph.
So you have this habit of, and this kind of nose for just digging and not necessarily believing, everything you see. But what is it about? I mean, you obviously can't research everything. So what is it that kind of gets you curious or lights up your sensors that something doesn't feel right here? Have you come up with is it just purely gut, or do you have, a set of, thumb rules for things that just seem off to you?
Now I have so much experience that every time I read something, I know that I have read something related to this somewhere else. Number one. And number two, if a business is not generating free cash flow and it is investing and it's valued highly, then you have to figure out why is it valued so highly. Is it because of its technology? Is it because of the potential? Or is it because there's going to be real growth in time? For instance, when Canada was in a building phase for its wireless business 10 years ago, 15 years ago. So you had the company Rogers Communication, and their capex was high. But what were they doing? They were building out the internet networks. They were building out the mobile networks. You could see the customers coming onto the network. Yes, there was competition in the market. Average revenue per unit could be going down. So you could say it could be a valuation issue. Maybe they are capitalizing some cost they shouldn't. But you also knew it was a real business which was building out. You could see it. So in that kind of a business, then it's more of a valuation story. But in other businesses, like the ones I mentioned to you, it's not a valuation story. And if it's a gut check story, it's a gut check story. But if something is too good to be true, actually, it usually is too good to be true.
How does that feel when you have published these reports that are critical of a company, and like the Yellow Pages one, the consensus of the other analysts or other investors is kind of like everyone is saying that you're foolish. What's that feel like? And, do you experience any self-doubt or wonder, go through that where, geez, am I the only one right out of 100 people? Or talk me through that experience emotionally.
Well, it has happened to me many times where people have said to me on my face and otherwise and consistently over a period of time that I do not know what I'm talking about. But that hasn't fazed me. It hasn't created any doubt in my mind. I was at a conference in Orlando with Jim Baldry and Mike Lazaridis of Blackberry. And when I started coverage on Blackberry, it was the world's darling. Awesome company, great technology, but looking at it from a rear view mirror. They completely missed the emergence of Apple, and they completely dismissed the emergence of Android. So I had been critical of them, that they were wasting and spending resources in other places where they should not be. And Jim Balsley should stop looking for a NHL hockey team and focus on his business, or he's going to have neither. And so in Orlando at that conference, there was a group of analysts, and Jim and Mike, and we were standing outside. I guess they were serving some food or drinks, and we were standing in the park gardens there at the Marriott, I believe. And I asked Jim, and they had just announced a stock buyback because the stock had fallen. And I said to Jim, why are you buying back your stock? And his answer was that because I can. And I said to him, but Jim, Google has $100 billion of cash, Microsoft has $50 billion of cash, Apple has $100 billion of cash. They are not buying back their stock. They are building and investing, and you are buying back your stock. He says, our board agrees with us. I said, but that's not a good answer. And so then he said, well, this is all I can say to you. I said, okay. But that's where you get into a question of strategic vision from a management standpoint and pushback. I had been in that place, in that position many times. Sometimes I've confronted people directly, and confronted in the sense I've discussed it, and they have confronted me, for instance, and I've also gone head to head with analysts. There was a conference here where when I was outlining my views on Blackberry and why Blackberry's technology, the superior, is behind the curve in terms of the touch interface and how consumers are responding to Apple and Android. And there were other analysts who were saying my view was not going to hold because that was inferior technology, etc. And that BlackBerry was doing what it was doing rightly. And it was in front of 1,000 people on a podium where we went head to head. But ultimately, unfortunately, BlackBerry, which was a Canadian tech champion, went bust. And Apple and Google ruled the world. What can I say?
Can you think of any examples where you made a call and the company has surprised you, and you did the research and you made a call that the company wasn't going to perform well, and you ended up being surprised by the results? Maybe they actually did grow and did succeed and surprise your expectations.
Well, there are two types of stock coverage. There is two types of stock coverage. One is you're covering stocks. Say, for instance, you're covering Google or you're covering Apple or something like that, or a regular grocery store. When you cover that kind of industry, some days or some months you're going to feel good because you said the stock's going to go up and it went up. Some months you're not going to feel good because you're going to say, oh, the stock's going to go up, but the stock doesn't go up. And then some months you're going to say the stock's going to go down and the stock will go down, and other months it will not. Because the businesses are mature and there's nothing churning unless something specific happens, like a tipping point. Whereas in the instances that I have discussed with you, it was evident that industries are changing and the businesses are changing, but the management is behind the tipping point. So BlackBerry was at the cusp of a tipping point in consumer behavior change and technology change, and it missed that. Yellow Media was at the tipping point of the consumer behavior change and technology adoption curve. It missed that. Timinco was just a fraud, so I won't even discuss them. And other companies, have taken place. So that's where the asymmetrical investment opportunity in the marketplace comes, is can you identify the tipping point for an industry or a specific company, right? That's what I would say. But yeah, I've covered tech and telecom for so long. There are times you can say, oh, the stocks are sell because you think it's 10% overvalued and the market doesn't care. But that's more of that's not a special situation, big call game. That's just coverage game.
Yeah. So you have moved on from the research analyst in equities. Talk to me about now. So now you're actually managing money. Tell us a little bit about your business.
Right. So I manage money, and what I learned over 15 years writing research and advising institutional investors is what is important. There's only two things that are important in managing money. Don't own a stock that is going to blow up. If you don't own it, you're already ahead of the market. And pay attention to corporate governance because it catches up with you sooner or later. You never know when. But once it catches up with you, it does not give you any time to exit. So the way my portfolios are structured and the way I manage money, I have something called the core satellite approach, which is pretty simple. The core of the portfolio, which is approximately 50%, is an asset allocation to various asset classes in the market. So to S&P 500, to NASDAQ, to Toronto Stock Exchange, to some REITs, some bonds, if need be, based on the type of the portfolio. And the other 50% of the portfolio is active stock picks, where I try to put my asymmetrical opportunities to test. And then we've been managing money since March 1, 2014. And in terms of the Canadian TSX, I think we are ahead of the TSX by approximately 6% annualized, and we're also ahead of the S&P 500, I believe, by 1 or 2% or more. And again, it's a low turnover, market data type of a portfolio, because clearly 50% of the portfolio is exposed to the market. So we're trying to capture the market return at the least possible cost with volatility in that component, which is kind of matching the market. And then fundamental research, investment picks, which provide the alpha. And again, they are the asymmetrical investment opportunities every year. If you can find one or two stocks, you just have to find one or two. And then over a period of 3 to 5 years, they work out, you're going to do well. So for instance, I won't Google in my portfolio since I started the portfolio. I've never sold a single share. In terms of percentage of the portfolio, it has stayed constant, but the stock keeps on going up. And similarly, most stocks we own, some of them we've owned since the portfolio started. They are still doing well, and I believe they will continue to do well. They may not, time will tell. And the other stocks, every year we add one or two and get rid of one or two. It's a long-only portfolio. There's no short.
And how can people, if they wanted to find out more about your firm and what you're doing now, do you want to point them to any website or location online?
Yeah, my website is www.antya.ca, and they can send me an email from there. They can come and take a look there. My website has lots of research I've written over time on Chinese stocks and Indian stocks and other stocks in general. Even now, I advise funds on managing money in asymmetrical situations, and I advise clients on go-to-market strategy. Currently, I'm working on helping a startup in the wellness and holistic wellness space with a go-to-market strategy for their product, which they plan to launch next year. And if boards are looking for independent advice on acquisition opportunities, because management, they tend to bring their bankers, etc., to the board. But many times, as we have seen in the case of when HP bought Autonomy was a whole accounting thing, a governance thing, which nobody understood, and that went bust. Caterpillar bought a company in China. It was a whole accounting and governance thing, and completely went bust. Many of the big, large-cap M&A acquisitions end up in problems because the board do not have an independent third party to actually look at the recommendation that is provided to them by management and the bankers who have their own incentives. So that's where also a lot of my expertise and knowledge comes into play.
Fantastic. So we will include that link in the show notes. Neeraj, it's been fascinating hearing these stories of how you've really, discovered this material about public companies, and great having you on the show today. Thanks so much for joining.
Thank you, Will. Thank you for having me. Talk to you soon.